Good day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to look at the second release of that first quarter GDP, and then look at the inflation numbers, follow that with some rates, and then end the briefing looking at deposit rates. So as we know, last week the second estimate came out for GDP, and it came out at 3.1%, just under the initial estimate of 3.2. But we can see that we similarly with the original, we saw a decline in the goods spending on the consumer side by 0.3%, but that was offset by the 2.1% growth in service spending. So we saw overall consumer spending coming down a little bit, but still contributing 90 basis points to the overall GDP. In terms of that investment component of GDP, we saw that contribute 78 basis points. Of that 78 basis points, 60 basis points was made up with the inventory replenishment. So we saw that have that lion's share of that 78 basis points. So that's fairly significant. We continue to see a decline in the residential fixed investment, so that real estate sector continues to come down a little bit inside that investment component. When we look at the government contributing 42 basis points, that primarily being led by the growth in spending by the state and local governments. And then we have the exports imports component, which contributed 96 basis points here, a fairly strong number. We'll see if this continues with the whole trade wars and the different tariffs that are going to come out and potentially the retaliatory tariffs. So that's where we see the first quarter GDP now at that 3.1. Most likely as we move throughout the year, we anticipate this to come back down probably below that 2% mark as we move throughout 2019. The biggest component is that consumer, seeing if that's going to continue to wane away in here, and that investment component. If we see that inventories not able to continue contributing a large amount, we could see that come down as well. Some negative factors or headwinds for the second and third quarter. But looking at the inflation continues to be rather low. We can see there is a slight uptick in the inflation, core inflation measured by that core PCE went up just slightly here in April. May won't be out until later this month. So April came up just a little bit. We're still fairly below that 2% target for the Fed. And when we look at the five-year forward inflation, we can see that the expectations is continuing to come down here. So this is kind of weighing in on those longer-term rates, which we've seen over the past couple of weeks come down fairly significantly. In fact, we see the 10-year treasury coming down to below 220 last week, and continuing that trend this week, being at around a 210. So we continue to see this downward momentum on the 10-year treasury. We see the overall yield curve being inverted here in the middle portion, where we have that 10-year treasury at a 214. This is as of the 31st, and the 3-month treasury at a 235. So we see us operating in that low to negative spread between the 10-year and 3-month. Now, typically when that happens, we see the short end of the curve start to come down. And we're starting to see that a little bit when we look at the changes in the short end. For this year so far, we're down a little bit, but not as much as we are on the longer end. So take that into consideration and thinking about long term. If that short end of the treasury curve comes back down, how is that going to impact your ALCO model? How is that going to impact your overall deposit structure in terms of the rates, but also those loans? If you have variable rate loans, how are those going to reprice in here? And if we look at the Fed, these are the Fed probabilities of a rate cut. And we look at this, and surprisingly, we have this even in the July meeting, we have a 55% probability of a rate cut, that jumping to 88% probability in September, and then to 97 in December. So pretty significant probabilities of a rate cut. And since we have our loans based off of prime for the most part, and LIBOR tends to follow the Fed funds rate, we can see that lower rate environment on that short end of the curve. Now, if we look out in December and we look at, well, where's that rate going to be? Potentially, we have a 13% probability it's going to be between a 1.25 and 1.5. You have a 32% probability between a 1.5 and a 1.75. And then we have a 34% probability of it between a 1.75 and 2%. So this could be a fairly 1-2 moves in here by the end of the year. So we need to take that in consideration. We should be running this type of a model or this type of scenario through our AL models to see what the impact will be in 2020 in terms of E values as well as in terms of NII. Overall, though, when we look at those deposit rates, we can see the national average or aggregate deposit rate for CDs continues to increase. These top two lines are the end of the year and then May 31st, and we can see they're still increasing in here. So we see this continuing to happen, but I believe we're coming to the end of those increases in the CD rates. In terms of the national average, when we look at the specials and those high values, we can see those have come down a little bit since the end of the year. We saw that 5-year and the 4-year and the 3-year and the 30-month coming down a little bit, but we have that sweet spot, the 10-month to 18 months, still increasing in here. In fact, that's where that sweet spot was for the 18-month, that high being at a 4%. But like I said, I think we're kind of at the top of the CD rates right now. They could either level out or potentially come down a little bit. However, when we look at the cash type deposit rates, we have a different story. We continue to see these cash type deposit rates creep up, which makes sense because we have had a much more significant lag in terms of increasing these rates. But within the money market, we can see that they continue to increase over the course of this year of 2019. I would expect that to continue throughout the summer, and maybe in the fall we start to see these numbers pull back a little bit. That's going to obviously have an impact on our overall cost of deposits and cost of funds, raising those two. And then in terms of our net interest margin, we could potentially see a margin compression throughout the third and fourth quarter of 2019. We start to see it right now in some banks, but I think more on a broader scope, we could see that happening throughout the third and fourth quarter of 2019. But this is going to be a big play. We see interest checking staying relatively the same, as well as savings account. The bigger movements that are happening are in those money market accounts. And then also we have the funds rolling from these money market accounts and the savings accounts into CDs, which is going to continue to increase your overall cost of deposits. Well, that's what we have for you today. We hope to see you back here again in the next briefing. Have a great day, everyone.